Hey everybody, how are you doing? Good afternoon from Brooklyn in New York City. Welcome to another video podcast of the Biotech Capital Compass. This is one of those video companions. It's that we publish whenever we do a deep dive on a note. We just wrote a note on the JPM, the JP Morgan conference takeaways. This is a series of conferences that happen in San Francisco from roughly around January 8th, 9th to about January the 16th, 17th, with the investment bank JP Morgan's healthcare conference being at the center of it all. And there's about, I think, 3 to 5 other sort of satellite conferences, and then a bunch of other smaller meetings and events and get together spread out over San Francisco and other parts of the Bay Area. It's really a lot of fun. I've been going since 2005. I did not make it this year. I think the second or the third time I might not have made it, but I was able to monitor it from Brooklyn. There's a lot of information that comes out. So, let's, on this video, sort of companion to that note, I'm going to, again, just talk a little bit about our takeaways from what came from this series of healthcare conferences that happened in San Francisco. It's almost like the Super Bowl of like healthcare conferences. And for us, it begins at the beginning of the year. So bear with me as I try to sort of take a very robust sort of newsletter that we wrote, some pretty deep fundamental research, and then synopsize it for those who just want to listen in for 5 to 10 minutes and get a quick takeaway. So, if you've been following healthcare for a while, you know that JP Morgan has a certain sort of rhythm. Big promises, big words, and a lot of people trying to convince you that this year is the turning point. It's been going on for 3 or 4 years now since our sort of last high around 2021. Every year, JP Morgan since then has been, okay, this is a turnaround. Things are going to start getting a lot better. And it has not been. But in 2026, what really stood out in the tone was really different for me. It was not euphoric, not defensive, more settled. Across media coverage, market behavior, company transcripts, biotech didn't sound like an industry asking for patience. It sounded like one trying to prove that it had learned something. So I want to walk you through the 3 signals that all point in the sort of the same direction. And let's talk a little bit about which are the 3 signals that I'm looking at before walking you through them. So one is the public narrative. There's a lot of articles published in the media. There's a lot of media members, some of them highly specialized, expert level media folks who are putting out a lot of content through video, through articles, through tweets, etc. And a lot of it sort of is going out, in real time over these sort of 5 to 10 days. So what's the public narrative and what's the takeaway from there? And this is, again, media, scientific, regulatory ecosystems, and these are mainstream outlets, trade press, and social platforms. So I sort of went ahead and sampled all of those. Then we look at the investor lens. So what institutional investors appear to most focus on in terms of meetings, positioning, and follow-ups. We looked at various ETFs. We looked at, institutional news flow across Bloomberg, both across newswires or across tweeting. They have sort of a social way of looking at it, the social sort of like activity that's going on. So we looked at the investor lens. Bloomberg is very expensive. It's about $2,500, $3,000 a month. Mostly, institutional investors trade on it. And so wanted to get a sense for what they were looking at. And then finally, the management signal, what company presentations and Bloomberg published transcripts from the JP Morgan Healthcare Conference were saying about priorities, pressure points, and near-term execution risks. So these were the 3 areas that we sort of looked at, to come into this, the newsletter that we wrote, and then also in terms of talking about this video companion, the takeaways from the newsletter. So first, let's talk about the narrative. Public media coverage this year was unusually consistent. There wasn't much talk of a biotech comeback or dramatic reopening of capital markets. Instead, the framing was sober: execution, capital discipline, realism. AI was everywhere. Even I was actually a little bit surprised watching from afar. I'm fairly proficient and comfortable with AI in terms of my job function, and I use it a lot for this startup business of mine, for both the Biotech Capital Compass and advisory boutique that I have. But this is the first time I really started hearing in healthcare and especially in biopharma a lot. But it wasn't really treated like magic. Coverage focused on infrastructure, labs, compute, proprietary data, not just algorithms. Obesity was still front and center as a disease, but now as an industrial problem. Supply chains, access, durability, and payer pressure. These were all issues that kept on coming up. This is fairly typical, kind of kept on coming up. Radiopharm showed up again, but again with a focus on constraints, not hype. The message from media wasn't biotech is back. It was biotech needs to deliver. Now, in this video companion, you'll see I have a word cloud that I've included in here. This is in the original newsletter. Also putting it for everybody to see. This video companion is free to everybody. And this word cloud really summarizes dominant themes from JP Morgan media and company commentary. So really, if you think about it, the center of gravity is still execution. That's what really comes across from like the sampling of of the broader media institutional coverage. Management teams were not rewarded for elegant science alone. Investors were listening for proof of delivery, hitting timelines, scaling manufacturing, navigating regulators, etc. Closely linked is infrastructure. People are really focused on that agentic AI in terms of being able to help companies all across healthcare, not just biopharma, biotech and pharma, but also med tech, hospital systems, et cetera. Agentic AI also is featuring prominently. So these were sort of like, the centers of gravity. This really hit a lot, as you can see from the word cloud. And where's capital flowing? This sort of next layer of the word cloud also tells you that, JP Morgan, the investment banks, conference and a lot of other sub-conferences are also focused on capital formation and capital investing. These are radiopharmaceuticals, have firmly moved into the spotlight. A few years ago, it was antibody drug conjugates. Before that, it was bispecifics. Before that, it was CAR T and gene editing. But this is the time of radiopharma. And this is not only for clinical promise, but also for infrastructure and supply chain barriers. Radiopharmaceuticals are unique in the sense that companies can actually have a moat built around the infrastructure they've built to deliver them. Novartis is a great example of that. Conversation for another day, but we will go there. Another disease category that was very hot was obesity. This remains central, though with more sober tone. Oral therapies, maintenance dosing, and durability over peak efficacy, were debated a lot. Bolt-on M&A was another area where capital is flowing, sort of was being looked at. This reflects a pragmatic deal environment, while the Biosecure Act underscores how geopolitics is reshaping manufacturing and licensing strategies. Biosecure has a lot of implications for China, and a lot of the just great innovation going on over there. But there's also geopolitics playing into this. Smaller but meaningful terms point to areas of tension: manufacturing and FTA, operational abilities for the FTA to do things. China reflects a dual narrative: source of innovation, yet a strategic and political risk. Independent hits at a quieter mindset, fewer companies positioning solely to be acquired, more aiming to stand on their own. So independence for small to mid-cap companies really was something that was showing up a lot in when you sample the public and the institutional narrative, which is a good thing actually, I think, in some ways, because that means that we're not just dependent on business and development, what's called license acquisition from pharma or M&A from pharma, in order to drive our sector right now. Now, heading back, let's talk about the market. So that was the narrative, and then the sections, if you look at the word cloud of what was the layering of the narrative and the areas of importance from top to least. ETF behavior backed up, that biotech needs to deliver. This really, was not a JP Morgan about biotech is back. It's more about biotech now needs to deliver. And the ETF behavior is actually kind of indicating this. The XBI didn't melt up, over the last month, but it did move. Since early December, we've seen real measurable re-engagement with risk, especially in development stage and clinical trial exposed assets. At the same time, volatility stayed high. Pullbacks were frequent. If you went back and looked at an analysis that we did, we'll be doing further, where we looked at the price of shares in biotech ETFs versus volatility of the ETFs versus how well the sector does. These three things are interrelated, and they don't all move together. So volatility has stayed high, which both can be for biotech can be both a good or a bad thing. Right now, my opinion is it's TBD, it's to be determined. But the XBI keeps on moving up, and more so than the IBB, which is the larger biotech company focused ETF, and that's important. This isn't indiscriminate optimism; it's selective risk taking, case by case investability, not blanket re-rating. Investors are willing to learn to lean in, but only when there's a clear path from milestone to value. So again, investors are not really thinking about, are you back, biotech? More like, all right, kind of convinced us that maybe you're back, but let's see, can you take this now further and deliver on some of this value that we've given to you over the last 6 months, when biotech really outperformed the broader markets, as we've published previously over the last couple of weeks. Now, third, and perhaps most revealing, what management teams actually talked about. So what we did was we went and looked at literally like 100 to 200 transcripts, and ran sort of like artificial intelligence and pattern recognition programs over that, and kind of looked at what were the themes that were emerging, from what management was focusing on across all companies at JP Morgan, not just biopharma, but also there are med tech companies, hospital companies there, but we were mostly interested in biopharma. So when you look at Bloomberg published, and these are transcripts available on Bloomberg, which publishes a lot of them. So the JP Morgan transcripts, the pattern is striking. The dominant topics weren't macro, rates, or geopolitics. They were clinical trials, R&D cadence, approvals, revenue visibility, margins, and cash flow. Corporate actions skewed conservative, buybacks, dividends, selective capital raises. Very little talk of leverage or transformational balance sheet moves. That should tell you something. Actually, management was talking about this, and one of the things in the public media, if you've been tracking JP Morgan, some of the takeaways is a lot of people, in the public media have been talking about, and even analysts at banks, about how there hasn't been any large M&A. Well, this is already kind of showing up in management presentations in these transcripts when management was really focused on buybacks, dividends, selective capital raises. This was also in the Q&A sessions. These are the areas of focus. Very little talk, like I said again, of leverage or transformational balance sheet moves. So we shouldn't be surprised by the lack of large M&A that hasn't really happened after JP Morgan. It still could happen, but at least the broader, general takeaways from management presentations in their transcripts was that they were less focused on that. Like legal and regulatory discussion focused on timing and IP durability, not ideology. ESG barely registered except when it overlapped with access and affordability. Access to us in biotech, biopharma means patient access. Affordability, of course, is price. Prices of drugs. So the ability, both sort of hint at, the ability for patients to get their hands on these drugs. And so that's where ESG really popped up when those topics would come up. So in other words, management teams weren't selling vision decks. They were giving operating updates. That's the through line of JP Morgan 2026. Biotech has moved from narrative repair to operational accountability. And that doesn't mean the risks are gone. Regulatory uncertainty is real. Infrastructure bottlenecks, especially in radiopharma and obesity, are real. Valuations are still fragile. But it does mean the rules have changed. Capital is being allocated less to promise and more to proof, less to stories and more to scorecards. That's not always comfortable, but it's often how healthier cycles begin. If you want the deeper breakdown, media markets transcripts, it's all in the accompanying Biotech Capital Company newsletter, Biotech Capital Compass newsletter that went out a couple of days ago. Of course, that's for paid subscribers, and so which is why we publish this video companions for people who don't necessarily want to spring for that $100 a year, of which, by the way, 10% Substack takes. So if you think that what we provide is valuable or is a deal, please be a paid subscriber. Otherwise, be a free subscriber. There's 3,000 plus of those, and you will keep on getting these nice video companions to help you in your biotech journey. As always, thank you for listening, and I appreciate you following along. Take care.